Welcome to a new subject for discussion under a very broad heading called Where to Invest. This particular presentation is a little bookish because it deals with various standard avenues of investment like bank deposits, small savings, etc. However, for a certain section of investors who want total safety and also a regular return, perhaps even for senior citizens, there is a challenge in today's environment where the interest rates have fallen. The interest rates on popular investments, especially bank fixed deposits, even for senior citizens, are hardly 7%. People want slightly more profitable avenues of investment. And in the process of explaining some of these basic investments to you, there are one or two insights which I think I can give you. So without any further delay, let us go into this presentation called Where to Invest. Now before we proceed further, this where to invest is mainly focusing on investments that give you a regular return. And we must understand where to place such regular returns investments. Investment is like a tripod, a three-legged stool used by photographers, for example. There are three purposes for which you can deploy funds. The first is what we call parking, where to park funds. The second is we can invest for regular returns. And the third, we can invest for growth. So when we talk about investment, let us briefly examine investment from these 3 points of view. And the first is where to park funds. Now, when we talk about parking, there are two aspects to parking. One is called pure parking. The second is emergency funding. I do not want to talk about emergency funding because I have dealt with this in a topic called personal financial planning. And those of you who might have missed it and want to know what it is, you would be advised to watch the series of talks under personal financial planning, which will be on the Simplest website. Pure parking is a little different. Imagine you have sold a property for 50 lakh rupees. And with this 50 lakh rupees, you want to buy another property. Now, property is not something that is available off the shelf. You just can't go to a shop and buy it. Sometimes the kind of property you want may surface within 2-3 weeks. Sometimes you may not be able to get a suitable property even for months together. Now you have sold one property. The money of that property has to be parked. It has to be ready for use when you buy the new property. Where do you invest such money? The answer is pretty simple, because the same avenues of investments which we use for emergency funding, from a humble savings bank account to something like a liquid mutual fund, to a mix of savings bank accounts and fixed deposits. They are called the flexi deposits, which are available with many banks. They call them swiping accounts. Certain amount gets SB interest. More than that, it gets the FD interest, depending on how long you are going to keep the money there before withdrawing it. Any of these are okay, but when you go into these kind of investments, you should also be a little bit aware of the tax implications. Many of them could be taxable. Today, even short-term non-equity mutual funds like liquid funds, other short-term debt funds, the appreciation that you get on this is fully taxable. It is only if you cross 3 years that you have the benefit of long-term capital gains. And when we talk about parking, generally parking, the implication is for a few days, a few weeks, a few months. Stretching the imagination, parking could be for 1 year. So you can be sure that even if you choose mutual funds, the return that you get on this will be fully taxable. There may not be much tax efficiency there. If you choose the dividend option, I agree that the dividends in your hands will be tax-free, but there is a hefty dividend distribution tax. Even the very basic dividend distribution tax is more than 28%. Therefore, no real advantage, but they will give you some decent return. We need not worry too much about tax, because tax is on income. You are generating some income. It's on that income that you are being taxed. Now, in a parking situation, as we have seen in the past, there are 4 objectives of investment which we mention by this acronym, AIMS: appreciation, income, marketability, security. Now, the moment you are talking about parking, it is marketability and safety that are important. Definitely not the returns. Tax efficiency also need not really be taken into account. When I'm parking, anytime I want the money should be ready for me. Which means it should be highly liquid. That's what we mean by marketability. And it should be safe. The money, the 50 lakhs that I kept for my purchase of property, I would not like that 50 lakh rupees to drop to 45 lakhs or 48 lakhs or even 40 lakhs. Never mind if it doesn't grow too much. It should be liquid, it should be safe. So these are the considerations when we look at parking avenues, and even long-term bank fixed deposits can be kept provided there is no prepayment penalty. If you suddenly encash them before term and there is no penalty, it is fine if the interest situation works out. So these are the avenues that we use for generally for simple parking. Now, in this presentation, my focus is not going to be on parking and it is not going to be on growth. It is going to be on where you invest for regular returns. And we are just going to examine a few of these popular investments and see whether there are 1 or 2 insights that we can glean from these. Now, one important point before we actually come to the first investment is there is one feature of regular returns where most investors make mistakes. What is this feature? We misunderstand or misconstrue the true purpose of regular returns investments. Regular return generally connotes a monthly or quarterly cash flow that should come into my bank account to help me meet my normal living expenses. Now, in our life, we have the first 20 to 25 years where we may not earn. We have the next 35 to 40 years, say between 20 and 60, 25 and 65, when we are highly economically productive. That is 3 to 4 decades. Then we have the retirement phase of life, which can also last 2 or 3 decades easily. Now, when we are talking about regular returns, I need a regular return to meet my expense. The implication of a regular return is that I am not earning a regular return. That is the implication. I am not earning a regular return, therefore I need my investments to give me a regular return. This implication is not understood by many. So when we look at a normal person's working life, let us say we have something like this, 0 to 25 years of age, 25 to 65 also, because people sometimes work a few years after retirement, and then 65 plus. So here, and here, many times people are economically productive in this phase of life. And when they are economically productive, their income generally comes from one of three sources. The first is employment. The second is business. The third is profession. I can get a job, I can run a business, I can be a professional. And from all three sources, we earn income. And we earn income for a significantly long period of our lives. And when we earn this income, in most cases we can assume that this income is enough to take care of our normal living expenses. In other words, this is our regular return. We are employing our human capital, our abilities, our skills. And because of those skills, we are getting a compensation in terms of this income. When we are earning this kind of regular return, it would be extremely foolish to put our savings in further regular returns investments. That is the major mistake that people do. I'm earning, all my savings are going into bank deposits. What am I achieving? I am achieving generating interest income. That interest income is fully taxable. When compared to growth avenues of investment like equity and real estate, the income is lower. It has to be, because I'm taking a much lower risk there. What's worst about this is, there is a concept called the real rate of return. The rate of interest minus taxation minus inflation. Very often over the long term, the real rate of return on regular returns investments turns out to be negative, which means after all my hard work, the money that I've got from there is not only not working for me, I'm actually destroying a small bit of it as we go along. So the foolishness is investing in regular returns types of avenues during our economically productive lives. Even when we retire, we have an option to withdraw from our growth investments. In an equity mutual fund, for example, there is an option called the systematic withdrawal plan. But probably I will tell that to you at the end of this series of talks. But there are a set of people who are not mentally comfortable with that kind of a strategy. They say, we will have all our growth investments, but a section of our money should be absolutely safe, should give us a well-defined cash flow every month or every quarter. And that money, we know, we don't have to worry about how we are going to meet our normal living expenses. And of course, once you are over 60, 65, 70, if you are the type of person who needs de-stressing, who needs a certain amount of mental comfort, by all means we respect that. Also, where tax is concerned, up to the first 5 lakhs of income that you earn, you really do not have to worry about tax, especially for a senior citizen, where up to 3 lakhs there is no tax because of the basic exemption. And the next 2 lakhs, you are today paying 5%. Tax does not bite at that stage. Tax bites once you cross the 5 lakh threshold and you go into the 20% tax bracket. So to fill in the first 5 lakhs of income, if you want to go in for some regular return type of investment, by all means, there is no problem. But what we must understand is, during this phase of our life, this very, very important phase of our life, because many times, this phase of our life determines how we will spend the evening of our life. During this phase of our life, all our savings must go into growth investments, predominantly equity and real estate. Then we can ensure a very fruitful and enjoyable last phase of life. So with this, let us now examine some of the regular return schemes that are popular. Most of it you can read off the screen. If I've got some insights to offer, I will of course offer. One of the oldest and most popular schemes that we have is something called the Post Office Monthly Income Scheme. Now the Post Office Monthly Income Scheme, the Kisan Vikas Patra, the National Savings Certificate, lot of these schemes, actually we call them post office schemes, but the post office is only front office. It's a collection center. It actually falls under an organization very few of us have heard of, called the NSO, National Savings Organization. These are only channeled into the National Savings Organization. Now, the National Savings Organization has made some fundamental changes over the last decade. First and foremost, all these small savings scheme of the NSO are now available only for residents. From the last 14 years, from July 2003 onwards, they have been banned for NRIs, not only for NRIs, also non-individual juristic persons. For example, trusts, provident funds, superannuation funds, gratuity funds, Hindu undivided families, HUFs. You can argue that no, we are all a collection of individuals. No, I'm afraid it's recognized as a separate entity. That's why an entity can have a separate PAN card. An HUF can have should have a separate PAN card. The Karta in his individual capacity has a separate PAN card. So, for association of persons, for all these types of people, the NSO investments have been banned. They can no longer invest in them. So, this is one important point to understand. Now, let us look at the first of these investments, the Post Office Monthly Income Scheme. In the old days, it would be a 6-year scheme with a small bonus. But from this date, December 2011, it is now a scheme of 5 years. The present rate of interest is 7.5%. But this is one of the very, very few schemes that actually pays you a monthly interest, not quarterly like bank deposits or half yearly like government bonds. It pays you a monthly interest by direct credit to something called the Post Office Savings Account, Savings Bank Account. Now the interest rate of the POMIS is reviewed every quarter. Sometimes it is changed, sometimes it is not changed. Roughly the base of or the basis for any change that is contemplated is the yield on the 10-year government bond. Some subsidy is given for small savers, so it generally tends to be a little higher than the yield on the 10-year government bond. From 1st of July 2017 onwards, the rate of interest is 7.5%. Now, there is a restriction on the investment that you can make. If the investment is made by a single holder, it is 4.5 lakhs. This is essentially for the middle class and the lower middle class. If it is a joint account, A and B together, then it is 9 lakhs. There is one interesting feature about this investment. Minors are considered as separate entities. In many of the other investments, minors are not considered as separate entities. For clubbing, for example, PPF, when you put what you put to a minor's account and your account as guardian, total is 1.5 lakhs per annum. But here a minor is considered a separate entity. What is even more interesting is, this is one of the few investments where a minor has independent rights if the minor has reached 10 years of age. Very interesting thing, which actually goes against the very minority law in India. Even if a minor is 17 years in India, the minor has no capacity to contract. It is only a guardian, either a natural guardian like either of the parents or both the parents of the minor, or a court appointed guardian who can act on behalf of the minor. But here is an investment where the moment a minor is 10 years old, the minor can go and open an account in the minor's name individually, need not be accompanied by any guardian. Not only can you open the account, the minor can also operate the account, withdraw, add more. So, one of the ways in which a minor can be actually taught a little bit of the basics of investment, that you can put some money, that you can do this on your own, that you can withdraw, and that you can from time to time write up a post office monthly income scheme or post office savings account passbook. And you can see that there is something called an interest element there that is credited to your account once in 6 months, or in the case of the MIS, of course, every month it falls into your savings account. So from that point of view, there is some benefit here, and very interesting because I have not come across any other investment where a minor without a guardian can operate this. And especially 10 or 11 years is not too old. In short, because a minor has an independent investment, if you have a family of 4, husband, wife and 2 children, up to 18 lakhs can be invested in the POMIS. And sometimes people who need a regular income, even at 7.5%, they can generate 10,000-11,000 of monthly income. Some kind of monthly income comes into this. So we have set these kind of things up for some of the poorer people, for whom sometimes even 10,000 or 11,000 rupees a month coming in makes a very important difference to their standard of living. Moving ahead, accounts can be opened by a single adult, 2 or 3 adults jointly, or a guardian on behalf of a minor. That is a minor aged below 10. Premature withdrawals are not allowed for 1 year. Liquidity, it is not very good. Thereafter, a penalty of 2% of the deposit amount will be deducted for withdrawals up to 3 years. So 1 year, you are shut out of liquidity. After that, 1 year to 3 years, if you withdraw, 2% of the principal amount is deducted. And after 3 years to 5 years, you cannot escape a penalty, there is 1%. So when we talk about AIMS, where M is concerned, this scores poorly. Interest also is fully taxable, but for the, like I told you, up to 5 lakhs of income, these are the kind of things that people should go for. Nomination is possible. You can nominate, you can hold things in joint accounts, and a very humble and easy amounts can be deposited in multiples of rupees 1,500, and there is no guaranteed investment offering higher monthly returns. This is an investment that is safer than any average bank deposit, because this is an investment guaranteed by the government of India. It's actually a government scheme. The NSO is nothing but an organization that channels money from the public to the government. So the public, the post office, the NSO, the government. It's an indirect kind of a government bond. Now, up to now, the only places to open these accounts were the post offices. Now, in the last 1 week, in the newspapers, we have been reading that very shortly banks, several banks, are also going to be empowered to collect small savings investments. So that will make it very much more convenient. It's just announcement has taken place. It will probably take a few months to actually implement. But it is just something to be borne in mind. NRIs and HUFs, I already told you, cannot invest. The nominee or legal heir cannot continue the investment after the death of the investor. Joint holders can continue the investment if one of the holders expires, subject to maximum limits prescribed. So a joint holder is always more powerful than a nominee, stands in a higher level than a nominee. Nominee can only receive, cannot continue the account. Nominee has to receive, And if the nominee still wants the post office monthly income scheme, with the amount received, a new post office monthly income scheme account has to be opened. But a joint holder can continue. So that much is more than enough introduction to the post office monthly income scheme.